Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. When we talk about markets, we spend a lot of time discussing valuations, growth, cash flow, returns, all the visible outcomes, But underneath all of that is a harder question. It's actually so basic it almost sounds naive, but I sometimes struggle with it myself because there's no clean answer. What's the purpose of your firm? And it's not as philosophical as it sounds, because every board, every CEO, every investor, they already answer the question implicitly. They do that through what they reward, what they tolerate, and also what they sacrifice when the times get tight. Some say the purpose is obvious, to maximize shareholder value. I grew up thinking that was the case, actually, but experience taught me that that framing has turned corporate life and financial markets into an optimization problem. And I refuse to surrender to that idea. Let's face it, most executives don't invent their firm's purpose. They inherit it. It's shaped by founders, by crises, and by the culture that took shape along the way. The purpose might have started as something aspirational to build, to serve, to innovate, but over time, operational efficiency took over and quarterly targets became the compass. Nobody notices the drift because it happens slowly and quietly. And it's just that every meeting starts to revolve around numbers. And there's nothing wrong with that, but numbers without meaning don't lead anywhere. They measure movement, but they don't measure direction. And that is the problem. Because when purpose gets diluted into performance dashboards and an organization, starts running faster without knowing why it's running at all. So a number of economic theories explain and predict the nature of a firm. But I recently came across and liked one by Bartley Madden, who is an investment thinker. He's focused on value creation and knowledge building. This is not really a book review, but his ideas resonated with my moral compass, and so I wanted to share some insights. Madden proposed that the purpose of a firm isn't to maximize shareholder value. It's to advance knowledge that creates win-win outcomes among all stakeholders: customers, employees, investors, and society. And not once, by the way, but over time. It sounds idealistic, but what he meant was deeply practical. Because he argued that every durable firm survives because it keeps building new knowledge. Knowledge about products, processes, people, competitors. And that knowledge then becomes a flywheel for innovation and trust. So Madden thinks profit isn't the goal. It's the, let's say, scorecard that tells you whether the knowledge system is working. In other words, shareholder value isn't the purpose. It's the outcome of fulfilling the purpose. Madden proposes that every company should live by a purpose made up of 4 parts. And that is the compass that guides value creation for all stakeholders, he thinks. The first part is to inspire through vision. And the idea here is that people work for meaning, not metrics. They want to work for a firm committed to behaving ethically and genuinely making the world a better place. And he gave the example of Intuitive Surgical, which designs robotic-assisted surgery systems. Their employees are motivated by the opportunity to make the world healthier, not necessarily just by maximizing shareholder value. The second part of that system is to survive and prosper through knowledge building. A firm, he says, must continually gain efficiency and sustain innovation, both. He thinks a company's survival depends on its knowledge building abilities compared to its competitors. And that is crucial because a firm that stops building knowledge eventually stops earning its cost of capital, no matter how efficient the processes look. The third part to that system is to sustain win-win relationships with all stakeholders. And that requires decision-making that prioritizes mutual respect. According to Madden, job satisfaction and employee retention improve when management nurtures a culture that prioritizes respect, which in turn, of course, strengthens the firm's competitive advantage. And the fourth part is to take care of future generations. And that means designing products and processes early on to minimize any negative impact on society, like waste or pollution. because doing so can actually reduce total product costs while reducing environmental harm, according to Madden. So when those four parts align, shareholder value appears as feedback that the system is working. If you think about it, most companies already have the pieces of this system, but they treat them as departments, not as a coherent loop. And Madden proposes that a firm should instead operate as a knowledge-building system, where every function regularly feeds learning back into the others. The aim here isn't to hit certain static KPIs, but to raise the firm's rate of improvement in knowledge building over time. So he proposes that firms should first set explicit learning objectives for every experiment. Not just what you expect to earn, but what you expect to learn. Then integrate results from those experiments across functions so decisions evolve from shared insight and not hierarchy. And third, investment choices should favor activities that expand know-how even if short-term outcomes or short-term return on investment is uncertain. And that view forces us to see value creation as the result of cumulative learning. And that compounding of knowledge shows up years later as competitive advantage, as brand trust, and yes, it shows up in valuation multiples. Madden connected this to valuation in a way that makes intuitive sense. He talked about the gradual erosion of excess returns as competitors catch up and as the firm stops learning faster than the market, what he calls the life cycle fade. By the way, we talked about this in episodes 4 and 8 if you need a refresher. And so Madden says that this isn't a game about defending margins forever. It's about continuously reinventing the source of competitive advantage through learning, of course. And that's what separates the firms that plateau early from the ones that keep going. It's why a company that keeps learning about its customers, people, and the ecosystem keeps extending its runway long after peers with similar assets decline. And that brings us back to what we actually price in markets. Every valuation model, every DCF, every trading multiple is at its very core a translation of expected future learning into cash flow language. Revenue growth, margins, reinvestment rates, they're all just proxies for how effectively a firm converts new knowledge into cash flow, into economic value. And that's why two companies with identical financial metrics can trade at very different multiples. So when Madden says shareholder value is the outcome, not the purpose, this is what he means. If we accept Madden's thesis, then the CEO's true role isn't merely to just hit profit targets, but to protect and accelerate the firm's learning momentum, to design the culture, the incentives, and processes that let new knowledge emerge faster and spread wider across the firm. And this approach still creates strong shareholder returns, according to Madden, just not through traditional financial engineering. And what Madden implied in not so many words is that purpose keeps the system alive long enough for profit to be sustainable. For investors, this angle changes everything because they've been conditioned to ask, what's the next catalyst? But maybe the more powerful questions to ask are, how does this company learn? Does management communicate lessons learned or only achievements? Does it listen to employees and customers in ways that refine the model? And when investors think that way, they improve their investment thesis. They simply recognize that financial statements are just the product of learning systems. The income statement tells you how well yesterday's knowledge performed. The balance sheet tells you how much of that knowledge has been stored as assets. And the cash flow statement shows whether those ideas are self-funding. So valuation becomes less about forecast accuracy and more about direction, about the rate at which knowledge compounds, according to Madden. So what's implied here? Maybe, just maybe, the purpose of the firm and the purpose of the individual aren't that different. Both are systems of learning to make better judgments over time, and both create value by turning uncertainty into lessons learned, into insight. And Madden's theory isn't unrealistic, in my opinion. It simply reframes what winning looks like. Because if we focus on building knowledge that serves everyone, the numbers will eventually tell the story. And maybe, just maybe, the firm's real purpose isn't to maximize shareholder value, but to maximize shared understanding. I am Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.